what is infinite banking? I would say two things. Number one, it is probably the most important thing an entrepreneur can do to sustain their success and for the person beginning, accelerate their success. The second thing is infinite banking. Imagine, imagine in your family between grandparents, your parents, yourself, your children, grandchildren, there is this pool of capital that anything anybody in the family was doing related to money, whether that be in purchasing birth announcements, retirement party planning, committees, purchasing vehicles for your 16-year-old, purchasing educations for your children, purchasing automobiles, purchasing businesses, real estate, whatever it is. Anytime any of those needs happen, any of those family members were able to go to that pool of cash and use it. And then within the family governance to say, if you use it, you must return it. If you had a family bank with that pool of capital where you could do everything that you needed, in essence, that is the end of infinite banking.
Well, I mean, just yesterday we were sitting in our passive income mastermind monthly meeting, and we had an estate planning attorney teaching us on Nevada Asset Trust. And he was talking about this. He was talking about that very thing, about how he had helped set up for, the patriarch of a family that now 20, 30 years later, he's watching after that person has passed, he's watching the family use those funds in order to carry out the mission. And one of the missions was charitable. He said this group gives away $10 million a year.
Wow.
And the family gets to participate in it because one of the family's core values was generosity. And I love that what you're saying there, Ernie, is that when you build something like this, and I think, high level for, if you're coming to this, you don't know what infinite banking is. You hear Ernie talking about this pool of money that you had access. We're going to kind of get down into the technical nitty gritty in a second, I would guess. But just really quickly, big picture, I think you're setting the vision for why is this important.
If you go into Nelson Esh's book, he has a page in there. It says, but I can get a higher rate of return. And I don't know the page number. It's not sitting in front of me. But you can flip through it and it says, but I can get a higher rate of return. This is JD's Excel spreadsheet, basically, of that same exact example. Someone's sitting there with $100,000 and they're saying, I can take $100,000 and I can go earn 15% in this investment. And so my $100,000 earning 15% is going to make 15 grand. That's pretty simple math, right? Well, if that person is in roughly a 40% tax bracket, then what will they net?
9,000.
9,000, right? It's over here. It just showed you that. Now, the thing is that if assuming this investment, they put 100 grand in, it's kicking out $15,000 a year for the next 10 years, they got to put that $15,000 somewhere. Now, we know good and well they're not just going to let it sit in cash for 10 years, but we don't know how long it's going to sit in cash, what percentage of the time, right? Between 0 and 100, we know 100% of it won't always be out. There's just no way to make that happen, right? There's going to be days in there. Might end up being weeks, may have been months, and those weeks and months end up being years, right? But if you took a simple part of it, you took $9,000 a year of cash flow for 10 years, that'd be 90,000, right? At the end of the 10 years, you got back your $100,000 investment, you'd have 190 grand. You with me?
I can do that math.
All right. So option B over here is to compare. This is what Nelson did in the book under the, but I can get a higher rate of return chapter. He said, well, okay, if I had $100,000 in my insurance policy's cash value, could I not put it in the same investment, Mark, earning 15% that you could?
Yep.
Okay. So wouldn't I earn $15,000 just like you did?
Mm-hmm.
Now, do I have to pay tax on my gain? Yes, I do. But here's one thing that I get to avoid is that if my $15,000, if I pay interest at 5%, that $5,000 in interest that I paid, can I use that to offset the income for tax purposes? That's called investment interest expense, isn't it?
That's called speak to your CPA.
That is, and I know we have a CPA on here. Just nod, Jay, if I'm using the right lingo. Investment interest expense, where you can borrow money.
Not a chance he's nodding.
He's still doing tax returns there. So you got $10,000 as your net expense. Now that at 40% gives me, that's what I owe in taxes, $4,000, right? So my 15,000 minus my 4,000 for taxes.
Nope, that's your cash
That's your
value
growth.
growth. You forgot about that, Russ.
Oh, that's my cash value growth right there.
So your
Assuming
100,000,
4%.
yeah, your 100,000 grew by 4%
That was
in the policy.
That's what that was opportunity cost thing you guys were talking about earlier, wasn't it?
Show enough.
This is where you guys are showing me the math.
There you go.
And then the 4,000 I have to pay in taxes minus the 5,000 I have to pay in loan interest. And I don't know why JD didn't put those in opposite order. We'll fix the spreadsheet for him. I have 10 grand. Now, I don't know about where you guys live, but in Alabama, it's 10 greater than 9.
Show enough.
Especially when you're an Auburn grad, 10 teeth more than 9. So now if we take that scenario out, we say, all right, well, my 100,000, right? I'm going to get 10 grand for 10 years. If I had that, I could put that back into the insurance policy, or I could start a new insurance policy. And if my insurance policy was earning 4%, that 10,000 of cash flow is $4,000, is earning 4%. It's going to grow to be worth 136,000, right?
Mm.
And then at the end of 10 years, can I take that 100,000 and repay the full loan balance?
You can.
Because I've been using this loan interest right here, this 5,000 to just keep the balance at 100,000. So I pay it off, but my policy, as you guys said, was earning 4% the whole time. So my 100,000 cash value is now grown to 148.
Mm.
So that plus the new policy equals 284. 284 is a lot more than 190, isn't it? Now, we all know that we probably wouldn't have left the money in the insurance policy nor the checking account for all 10 years. But have we already proved that if we will borrow the money and go do something else with it, we're still going to have more money from the insurance policy than the checking account?